Good morning, and thank you very much for the opportunity. I guess you could call me a little bit of a hybrid. I spent 20 years of my career in the traditional finance world, and there you can think about boardrooms and spreadsheets and probably too many coffees, but also managing or helping manage, billions of rands of institutional assets on behalf of clients when Bitcoin was really just a little bit of a whisper on the internet. Now I've crossed over to the light side, or the decentralized side, however you want to think about it. In 2023, my business partners and I co-founded a business called MidSquare, which is a cryptocurrency asset management business. And essentially what we've done is we've moved from managing assets in a slow, heavily regulated suit world to one that's embedded in the Ethereum and blockchain world, everything decentralized and fast and wild, I guess, if you want to call it that. So I'm here to talk to you about institutions today, and we'll get on to exactly what institutions are. But essentially, they're my former colleagues, and some of them will still raise an eyebrow when you start talking to them about crypto, but they have come to the table. And I'll try and tell you what's bringing them to the table, why they're here, and ultimately how we bridge this gap between the banking suits and the crypto hoodies. So I'm going to start with a clip. It's a little bit over a minute long, and if you talk about institutions and in particular asset managers, this is probably one of, if not the most important guy in the world from an institutional perspective.
Now, I know you have been a leader in willing to embrace crypto. You have made it so that people can be in Bitcoin. We hear that you are thinking about Ethereum. These are incredible things. Now, BlackRock is not known as a gunslinger by any means, so you obviously must believe that this maybe is an alternative. Is this an alternative in order to be able, because of a deficit, maybe something long-term people should have?
Absolutely. As you know, I was a skeptic.
Yes.
I was a proud skeptic. And I studied it, learned about it, and I came away saying, okay, my opinion 5 years ago was wrong. Here's my opinion today. This is what I believe in today. I believe the opportunity today. I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency, debasing their currency by excess deficits, and some countries are. I believe we have countries where you're frightened of your everyday existence, and if you have an opportunity to invest in something that is outside your country's control, then you can have more financial control. And so I'm a major believer that there is a role for Bitcoin in portfolios. I believe you're going to see that as one of the asset classes that we all look at. I look at it as digital gold, as I said before.
So, importantly, if you don't know, BlackRock is a $10 trillion asset manager. It's the biggest asset manager in the world. 5 years ago, Larry Fink, who's the chairman and CEO, called Bitcoin a network for money laundering, and he said cryptocurrencies would have no role in institutional portfolios. That was from July this year. It's time-stamped with the Donald Trump first assassination attempt. And I think you can hear the change in the tone, okay? Just to give you a little bit of a sense of when we talk about institutions, or when I'm talking about institutions, what am I talking about? I'm talking about banks. So up on the slide, you'll see the likes of BNY, JP Morgan, Goldman Sachs, insurance companies, Discovery, Sanlam, Old Mutual, the ones you'll be familiar with here in South Africa. Listed companies, MicroStrategy probably being the most famous one, Michael Saylor's company, listed in the US, and many predicting we'll get into the S&P 500 at some point. Countries, governments. So bottom left of the slide, the Venezuelan flag, or El Salvadorian, not Venezuelan. El Salvador has adopted, Bitcoin as a reserve asset in the government. Transacting in Bitcoin in Argentina, bottom right, is quite normal now. Institutions, so pension funds. The state of Wisconsin pension fund in the middle of the slide there is a $180 billion fund that now invests in Bitcoin. And then lastly, asset managers like BlackRock that you saw, Chairman and CEO Larry Fink there, Fidelity, and of course our business MidSquare, which is also a cryptocurrency asset manager. So when we talk about institutions and what they're doing, these are really the guys we're talking about, and we'll get to why their entrance into cryptocurrency is important. But to bridge the gap, so how do you get people like Larry Fink and banks and people who think about the world from a cryptocurrency perspective quite differently to a lot of people who are native to the space? How do you get them in? And essentially I'll talk about what I think are 3 of the main catalysts today, and we'll touch on each of them in a second. But those 3 catalysts are really regulation, infrastructure, and an investment case. So if we just touch briefly on the first one. Now I know to crypto natives it may not feel this way. It may not feel like crypto was a wild west before regulation. In fact, if you talk to many crypto natives, they would feel that we shouldn't have regulation in the crypto ecosystem. But regulation is a must if we're going to start crowding in some of the institutions. And why is it a must? Is because institutions, they have a fiduciary responsibility. So they often act on behalf of clients, and they have a responsibility to those clients. And what regulators bring is some form of protection. One for the institutions and 2 for the clients, and they create regulatory frameworks under which these institutions can exist. And I really think that 2024 is probably a bit of a watershed year in terms of regulations, particularly with the approval of the Bitcoin spot ETFs in the US in January this year. So if you want to think about it from the institutional perspective, crypto would have probably historically been viewed as a bit of a wild west, and if I go and speak to some of my former colleagues now, I'll still hear things like scammers, Ponzi scheme, pyramids, all of those things, which you all know it's not. And you had regulators around the world coming into the space, the VARA in Dubai, very progressive. The SEC is still quite on the fence. They've been forced to do some things like approve the Bitcoin spot ETFs, but have also acted very much against the crypto industry in the US in many other ways. The FSA here in South Africa, actually quite progressive as a regulator, issuing licenses, forcing people offering crypto services to be licensed. MiCA regulations in the EU, and then the FCA in the UK also starting to seem quite progressive from a regulatory perspective. What has all that meant? So what does crypto look like post-regulations? You start to see headlines like this. And I won't read through all of them, but effectively some of the big endowments in the US getting into the crypto space. Some of the asset managers, Fidelity in the top right corner there is probably one of the top 5 biggest asset managers in the world. So regulation definitely creates a more positive environment for institutions to start coming into the space. Infrastructure can mean many things, and yeah, I'm not talking about hardcore infrastructure, that you might be used to. But if you think about these 2 worlds of traditional finance and decentralized finance, and if you take a bit of a, let's call it a maxi view. A maxi view would be that the whole traditional financial system must move on to blockchains and into the decentralized world. And maybe ultimately you get there, but you don't get there, in one step instantaneously. You're still going to have these 2 very different ecosystems, the traditional finance rails and decentralized finance rails operating, probably in parallel for a while, but they are quite different. Traditional finance has vehicles and access points like mutual funds, ETFs, custodians, 9-to-5 markets, so the markets don't operate 24 hours a day, long settlements, cost inefficiencies, and they're largely built on institutional trust. You have to trust your bank or your asset manager to do the job for you. Decentralized finance is about tokens, blockchains, 24-hour markets, instant settlement, censorship resistance, as you know, and is built very much around the idea of cryptographic or programmable trust. You don't need the institutions in the middle. But what you have seen happen is that on the one side, in the traditional finance world, we create access points in the traditional finance world to access digital assets. So you set up something like a Bitcoin ETF. So an ETF is a very traditional wrapper that's known to traditional finance, but the asset that's held inside that wrapper is a digital asset. It's spot Bitcoin. Conversely, on the other side, you find ways to use blockchain rails to get into real-world assets. Tokenization is the easiest way to understand that. And the simplest way to think about tokenization is really stablecoins. All stablecoins really are tokenized dollars or whatever you want. So there we use blockchain rails to access traditional assets. In the case of ETFs, we use traditional vehicles to house digital assets. And BlackRock has launched a US Treasury fund as well recently called BUIDL on the Ethereum blockchain. That fund is now approaching $1 billion. So that's using blockchain infrastructure to house US Treasuries underlying. So if we talk briefly about the implications of this or what happens if you're able to do this. So what happened after we were able to launch spot Bitcoin ETFs in the US? You had collectively more than $18 billion of new money flowing into that space in a period of 8 months. So that's up until the end of August from January. The previous record for any ETF ever launched historically was $5 billion of new flows in 12 months. Okay, so you had historically best achievement by an ETF, $5 billion in 12 months. The Bitcoin ETFs got to $18 billion inside 8 months. The iShares Bitcoin Trust alone, BlackRock's fund, did more than $20 billion in net inflows for the year to date. Okay, it's quite an astounding number if you think about it in the context of ETFs historically. The Bitcoin ETFs had the highest institutional adoption of any ETF ever, more than 1,100 institutional holders in the first 2 quarters of this year. The previous record held by the Invesco QQQ Trust had 374 institutional holders. It's almost 3 times as many institutional holders as the previous best. And if you think about this, collectively the spot Bitcoin ETFs have more than $60 billion in AUM in the 9 months that they've been running from January to the end of September. Gold ETFs have been in existence for 21 years. And often you would hear Bitcoin compared to digital gold. In the 21 years that the gold ETFs have been around, they accumulated $250 billion of assets. So in 9 months, the Bitcoin ETFs accumulated a quarter of the assets that the gold ETFs have done in 21 years. Okay, if you think about that and contextualize, give you a sense of how much institutional money has flown just in the first 9 months. Okay, the investment case. So without being disrespectful to retail investors are generally speculators. Okay, they believe in number go up. They want to invest in an asset because they want to see strong returns from it. Yes, institutional investors want the same thing. But the reality about institutional investors is they have to find an investment case. They must believe that there is an investment case in the asset before they will actually invest. So with the absence of an investment case, you're not likely to get institutional investors into the space. Most of my former colleagues in traditional finance tell me, I don't know how to value Bitcoin. So if it's trading at $60,000 today, can you tell me how do I value it? What are the discounted cash flows that are going to value the asset? However, as you heard from Larry Fink earlier, there are some other arguments. And this slide I've actually borrowed from BlackRock. It's a slide that they're taking out to all of their clients now. And there's a couple of things worth noting here. The first is that they only talk about 2 cryptocurrencies, Bitcoin and Ethereum. Okay, there's quite a simple reason for that. These are the 2 largest cryptocurrencies. And if you think about the volume of money that can flow from the institutional asset holders into cryptocurrencies, these are probably the only 2 that can absorb that volume. So for now, these are the ones they'll focus on. And they position them very differently. They'll talk about Bitcoin as a safe haven asset, one that they will use when there's fear, as Larry Fink said earlier, and people are fearful of the world and want to go into a safe monetary alternative. With Ethereum, it's much more bet on the adoption of blockchain as a long-term replacement for the financial infrastructure today, and therefore much more of a risky position, something that they would call risk on. The other thing that's important to understand here is institutions won't see the world as we take all our assets and move them into cryptocurrencies. They'll start looking at the world from a diversification or a portfolio construction lens, as they call it, which is that any portfolio is a blend of assets. It's got equities and bonds and cash and all sorts of other things in it. And the question institutions will ask themselves is, how do I actually get, or is there a way for me to hold crypto inside my portfolio? So this is just a little bit of work that we did at MidSquare to give you a very high-level feel for it. So what we've shown you here from the bottom up is for the main asset classes in South Africa, the different ones: equities, bonds, cash, property, foreign equities and foreign bonds, what have the annual returns of those different asset classes been compared to Bitcoin? Just one cryptocurrency. Now, we can get into a very long discussion about why Bitcoin's returns look the way they do, but I think the point here to make to you is that a typical portfolio for an investor in South Africa that an institution would build would largely hold those 6 asset classes, including Bitcoin. And the question that you then have to ask is there a role for Bitcoin in the portfolio? And if so, how much do I allocate to it? And then where do I take the money away from? So do I sell some cash? Do I sell some equities? And do I allocate it to Bitcoin? And I promise that I won't be explaining this side in any great detail. But what this is simply a Monte Carlo simulation, which is that we run thousands of simulations and try to figure out from those simulations what's the optimal allocation of Bitcoin in a portfolio. And the question we're simply asking here is, what's the optimal allocation to Bitcoin to significantly improve the return without really significantly enhancing the risk that you take? And as it turns out, and this is consistent with research that you'll find around the world from Galaxy Digital or even BlackRock themselves, depending on the risk profile of the portfolio, the optimal allocation in a portfolio is 3 to 6%. Okay, so you shouldn't take your whole portfolio and move it to Bitcoin. You should start allocating and diversifying at a level of about 3 to 6% in the portfolio. Now you might ask, why is all of this relevant? Why should we in a room care about institutional investors coming into the cryptocurrency space? If you think about all the capital assets in the world, so everything that counts as a capital asset, from money market to treasuries, bonds, real estate, equities, art and collectibles, gold, put all of that together, it amounts to about $900 trillion. Okay, so $900 trillion of capital assets in the world. Of that, currently Bitcoin is $1.2 trillion. 1.2 trillion of 9. If you do the percentages, I think that's like 0.012% or something to that effect. Okay, most of these assets are controlled by institutions. Those guys that I put up at the beginning of the slide. So if you want more money coming into crypto, more of this money, institutions have to buy into it. And I figured that you couldn't come to a cryptocurrency conference and not make a price prediction. It seems like the natural thing to do. So if everybody listens to MidSquare, all those people who control that 900 trillion of assets listen to MidSquare and they allocate 6% of those assets to Bitcoin, okay? That equates to $54 trillion. $54 trillion moving to Bitcoin at a supply of 21 million, which you all know is fixed, equates to $2.5 million a coin. That's how number goes up. That's not financial advice. And that's the end of the story. So thank you very much. I hope you found it insightful, and I'll be around if you want to ask questions during the break.